Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll sprinkle in my opinions as we go. It's generally related to three different topics: wealth building, financial topics, and or commodities. So let's dive in there. Let's see what people are talking about, and I will openly discuss some of the opinions that are being shared. If you want to follow me at Finance Score Finance on Twitter, or you can join our community, finding-value.com, where I dive into individual sectors, individual companies, and freely share my opinions about those companies. But you have to make the final decision on what you want to do. We still have a discount coupon code, LEAP, LEAP, if you're interested. So, investment wisdom. Howard Marks says the relationship between price and value holds the ultimate key to investment success. Buying below value is the most dependable route to profit. And I know that makes sense, but let's make some uh, realistic comparisons in real life of investing. I mean, yeah, this is obviously good advice or good information to know, but how do you use it? How do you know something's of good value? How do you know that the price is below the value? And that's why I created the three pillars: the technical analysis, ratios, and market conditions. Market conditions changes the perception of the value of that asset, which means the price goes up. Ratios is what is an objective way to objectively look at asset versus asset and compare it to history to see what's cheap and what's expensive. That is the value of the sector. And you can tell if the price is below the historical value when priced against other assets. Otherwise, you don't know what the value of that asset really is. And technical analysis can help us with tops and bottoms and breaking out of bottoms. So we're looking for an alignment between technical analysis, ratios, and a potential shift in market conditions. That's where the best buying opportunities in the market possess, because you can buy something that is extremely undervalued. The price is, and let's just say that sector is out of favor at that moment or out of that market condition. We see that the market condition is changing where it's going to come into more favorability, and then you buy it and you hold on to it. I mean, it's really that simple. Here's Warren Buffett. He says, you need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And that's where you have to think away from the crowd. You can't just fall into the crowd, which the majority of people do. I see it all the time on Twitter. Most people are just parrots of other people's ideas. They just parrot is repeat what other people think. So someone comes up with an idea, and then everybody else just becomes parrots, and blah blah blah, the same idea that this other person says. I see it all the time. You have to think for your own and think outside of the crowd, which is incredibly difficult for most people to do. One, it's incredibly difficult for most people to think. Number one, but number two, it's really hard to take an opposing viewpoint to someone else. And you don't want to take an opposing viewpoint just to take an opposing viewpoint. You want to take the viewpoint that is right, and that's going to make you money. It doesn't matter what other people think. It matters where the money flows next. And if you're there first and the money comes flowing to you, that's what revalues the asset. Manish, I don't even know how to say his last name. Regardless of the quality of the business, no business should be above its intrinsic value. Buying a business above intrinsic value is not investing, it's gambling. You're just hoping that other people will pay a higher price for it. If you buy a business that's drastically under we'll call it the true value of the company, the intrinsic value, you're buying it at a discount, and then you're just waiting for the market conditions to revalue it under a different market condition, where it could be fully valued or maybe even overvalued in a certain market condition. The problem is when you buy a business and you are overvaluing that business, you're paying more than what the business is worth, that is where you get into a lot of risk. That is where you need to know your technical analysis. You need to know your market conditions and your ratios. You can tell when things get expensive and when the risk starts to increase. So just like this guy is saying, buying a business above its intrinsic value is not investing, it's gambling. I completely agree. So really what you want to find is you want to find the undervalued companies, the companies that are out of favor in a bad market condition, buy those. Then when they come into favor, you sell them when they're in favor and they're overvalued. That's the whole name of the game here. There are only two types of people, those who can't market time and those who don't know they can't, which means you can't market times, according to T. Smith. Charlie and I never have an opinion about the market because it wouldn't be any good. And it might interfere with the opinions we have that are good. And that's about market timing. A lot of people don't think you can market time. So what you do is you find companies that are undervalued or sectors that are undervalued or out of favor, and you buy those. That's the only thing you can do. Then you wait for the market conditions to change. I think what they're saying is you can't really time the market in the short term. And I agree with that. In the longer term, you can definitely say that things are cheap and that we could potentially be turning because of these factors. That, I think, is a lot better approach to the market than the short-term day trading, short-term swing trading type mentality. And here's Peter Lynch, another one. He says, I love volatility. Human nature hasn't changed a lot in 25,000 years. Some event will come out of left field and the market will go down. Volatility will occur. That presents a great opportunity. And that volatility is what causes the company to be below its intrinsic value, is that fear of selling, that fear in the market. That is where the opportunity lies, is it creates the value in the market for you to buy when the price dips way below the value of that asset. Oil is driving rates, not the Fed. I've said that before. Oil and rates are very well connected. Now, here's the thing. When we look out a few years, I think oil and the pumping capacity of the world might get tested. If it gets tested, the price of oil could go up dramatically, which then also means that interest rates could go up dramatically, which also means that gold and silver could go up dramatically, which is different than the past 40 years. What happened in the past 40 years is interest rates would go down and gold would go up with bonds to some extent. Not every single time, but for the majority of the time, it was like that. What I am saying is people are going to be afraid to hold bonds and currencies at some point. And gold and silver are the relief valve for that value. They're going to say, I need to buy something of value. I don't want to buy bonds anymore. And I'm getting scared of the inflation in the currency. That occurred in the 1970s, and I think it's going to occur again in the future. That same type of market condition where rates and oil go up together and people become afraid of bonds and currencies. Your time not to buy fancier stuff. I completely agree with that. And that's how that's basically the vision I am. My vision is I'm using my wealth to control my time, not to buy crap. So, I mean, that's my philosophy at least. Josh says, when a company goes from crappy to less crappy, the stock goes up. When it goes from less crappy to good, the stock goes up more. And when the business becomes terrific, get out, says Peter Lynch. I totally agree with that. You buy stuff when it's down and they look really crappy. They're not earning a ton of money. They might be losing money in commodities. As the commodity price comes back into favor, that is when crappy becomes less crappy, crappy becomes good, and good becomes terrific, and then you get out of it. But you can also look, some companies can become terrific very early in the cycle and become even way more terrific by the end of the cycle. And that could be 30, 40, 50, 100 times your money in a 10-year period. That is what I'm seeking in the markets. That is what I'm looking for, are those opportunities to multi-bag over time because of the value and the service and or commodity goes up, unlocking even more value. I hear you, but what's behind gold is what somebody said. And this is in response to crypto. This is what I like about gold and other elements on the periodic table. So all wealth in this world comes from about two different things. It comes from owning real estate or the commodities on that real estate. And wealth can also be created by configuring elements on the periodic table into usable products using energy. So the wealth came from real estate or mineral rights. The second thing is the configuration of those elements creates a car, creates a trampoline, creates a house. And the configuration of those elements on the periodic table is what determines the value of that end product. So when someone says Bitcoin has all this value, every single thing in human history that was created by man as a currency has gone to zero outside of using elements from the periodic table, which is copper, gold, silver, and other elements. The elements are created from the exploding star or are found on Earth that may have came from outer space, like a asteroid hit or something that has platinum group metals on it. But most of this stuff is here, and that's the value. It's a physical element. So gold has value because it's a physical element on the periodic table, and it can be configured into designs that people have. Bitcoin or crypto is a man-made thing that is designed a certain way. A design is not perfect by man, and most likely something will happen whether the design goes out of favor, like a style of clothing might go out of favor. The design can be broken, where you can't think of absolutely everything that can break it, and over time, something can break it, like a supercomputer can break blockchain, or all of crypto that has a limited amount will end up in dead people's accounts over a long enough period, or miners not being subsidized by the Bitcoin itself is going to transfer astronomical fees to the end user when they can't mine it anymore, or when the cost of mining goes up an astronomical amount and miners are reluctant to mine anymore and they're going to put large fees. All of that and the design of it is what will break Bitcoin or other currencies, or a new one may come along that is much better at doing the same thing, which will literally design it out of existence. So the reason gold is so good is because it's an element on the periodic table that humans have found to use as a store of value or accounting. Many people would probably say math, but math is behind everything. I say much like the US dollar, it's literally just the belief that it is worth something. There is perceived value due to limited supply, but we can trade fractions of BTC, so supply isn't a huge issue. But it is, guys. Having a limited supply of nothing does not mean anything. It doesn't give it value. There's a limited supply of Hot Wheels. Does that give Hot Wheels a value of $69,000 or $70,000 per Hot Wheel? No. It's all just an assigned value during a certain market condition that people give it. Now, what I would say is, what utility does Bitcoin bring to humans? And that is the real question, because I don't know. Bitcoin is not a store of energy. It's not like you can unlock energy, and we fictitiously created an energy consumption thing with Bitcoin. It's not an organically driven solution to something. It's all made up by man, and that's where I think it's going to fail. something with the design of it is going to bring it to its knees. And I don't know what it is yet. John Palmy says, is artificial intelligence a stealth uranium play? My answer is artificial intelligence is a stealth natural gas play. Natural gas is the largest benefactor of coal going away, and natural gas plants have been put in place. The majority of the power grid is now powered by natural gas, and renewables are not stable enough. So natural gas, I think, is going to be worked overtime, those power plants. I think natural gas will be the main winner in artificial intelligence and the energy consumption of electricity. I think it's going to be natural gas. The reason it's not uranium, because it takes too long to put it into play. So natural gas will be the benefactor for, I think, the next 5 to 10 years. And then after that, it might be uranium. If they can mine it and build the nuclear power plants and or the small modular reactors. Maybe. If you don't know AI, you're going to fail, period. End of story, says Mark Cuban. Now, here's a question. AI, let's say AI is as good as what everybody thinks. So AI is absolutely excellent. It creates all these designs that we can now sell at infinite amounts. Where's the stress in the system if AI is successful? What it's going to do is it's going to eat a crap ton of energy, because in order to mine all of the materials, those elements on the periodic table, in order to mine all that stuff, we're going to have to mine it out of the ground and use energy. Now, the only thing that AI can really do is figure out a way to make something from nothing. Artificial things made from I don't know what is where it's going to have to go. But it's still going to consume energy. So if we're going to build a lot more stuff and artificial intelligence is going to make us that much more efficient, it means that our energy consumption is going to ramp up exponentially. That's what it's going to mean. And the biggest benefactors in the short term are going to be oil, natural gas, and coal. Longer term, it could easily be nuclear power and uranium. But we need to ramp this massively if they think this is going to be so successful. It's an energy play, in my opinion. Never forget this internal Boeing email. If the government doesn't do something, we're going to have a disaster. Well, the government did do something, and they created the disaster. It says, designed by clowns, supervised by monkeys, internal Boeing messages. I don't know how to fix these things. It's systemic. It's culture. It's the fact that we have a senior leadership team that understand very little about the business and yet are driving us to certain objectives, one employee wrote. Well, that's like that in most of the companies. And it's driven by design, by the DEI objectives that these guys put in place. It was at the company I worked at. They don't care about it's not based off of merit. It's based off of how, what gender you are and how you were born. So here's another one, Dan, the clock is ticking here. She's always talking about supply. A huge wave of housing inventory hit the market in February. I like RevCap. He says, this is the national listing data. Yeah, a huge wave came online here. Just a huge wave. Just like 2012, huge wave. Guys, we are still at incredibly low inventory levels. New listings did go up, yes, but it's not a huge wave. It's not this huge wave of housing inventory. It's still down here. So on a percentage basis, yes, it may look like a huge wave has come, but it's coming from a level that was basically zero. So any sort of addition to the inventory is going to look like a gigantic percent number when you divide by zero. I mean, I don't know. Fourth grade math, guys. Or maybe fourth grade math. That's what my fourth graders doing is division. Fourth grade math, and these people can't figure it out. Chart of the day for NVIDIA bros. Cisco was the NVIDIA of the tech bubble. 25 years later, the stock still isn't anywhere near back to its bubble highs. get ready because NVIDIA is going to probably go this route too as it comes back down at some point. There has been a significant underbuilding of housing in the U.S. following the post-Great Financial Crisis. Underbuilding might have created a shortfall as large as 8 million units, which will create a substantial tailwind to new building given only 1.5 million units are built per year these days. So we're at 1.5 million back here, and here we are at this big deficit, minus almost 8 million of underbuild. And I know I read some of these articles, guys, or some comments on Twitter, and they're like, there's never been more homes per capita than today. It's like, yeah, but those homes aren't for sale. I don't know why that data would matter. That's like saying there's more cars that have always, there's more cars on this earth than ever before. And it's like, well, if no one sells anything, there's nothing being purchased or sold, right? You have to sell those homes. They got to come into the market. They got to be in the right locations. A house or a second home or a third home that someone owns on a lake somewhere is not going to satisfy the demand that needs to be, 1,000 miles somewhere else in Utah, let's say. It's like, it doesn't matter. You got to have the homes in the right location and the right configuration that people need and want. Coming down, we've got beware of the 10-year. If this weekly uptrend continues, it will likely create a headwind for risk assets as we could potentially be going up. What's driving it? Oil's driving it. Oil is driving it. Blue is the ETF TQQQ, 3 times leverage QQQ. Orange is the price of Bitcoin. The measure is the cumulative change in price from 2018 to yesterday, which is 6.25 years. Effectively, they are the same thing. If BTC is something different, digital gold, hard money, a new financial system, the world computer, why has it traded like an over-leveraged tech stocks for well over half a decade now? It's because it was created and born in this tech world. And I think that Bitcoin's going to follow what the tech area does. So if tech stocks decline, I think Bitcoin's going to follow with it. That's my guess. What's going to cause it to decline? Increasing interest rates, higher oil prices, and a commodity bull market will. That's my guess. Okay, next. Chinese copper stock levels are through the roof. They are probably preparing the bazooka for Q2. China copper stock levels have surged here in 2024. Maybe they're trying to do something, like maybe this is kind of like war or something, or maybe they're ready to build something. I don't know. But they have surged. JC says, oil refining companies are breaking out to new all-time highs. I'm sure it's nothing. So oil refiners are coming out of a massive base to new all-time highs for crack spreads, or crack is the ETF, I should say. It looks pretty good to roll on higher for refiners. President Joe Biden has proposed an annual tax credit that would give Americans $400 a month for the next 2 years to put towards their mortgages. Americans may therefore get a $9,000 600 tax credit to buy a home. Should this be implemented? Obama did this. I think it was $8,000 tax credit or something. And this is an incentive for people to buy homes. This is also part of the real estate cycle, where when real estate gets expensive and affordability goes down, government tries to help people buy homes, get into homes. It's going to drive a gigantic housing bubble, most likely towards the end. We're not there yet, but we could be at some point if we overbuild, which we're nowhere near overbuilding yet, not even close. Patrick says, what do you mean Bitcoin isn't just another tech stock just like Adobe? But look at Adobe, guys. So Bitcoin's in the black. We've got it coming up here. Adobe has already turned over, and it's right at its breakout line where we could be basically doing a double top. Says, it is all about capital flows, not the narrative. And here's your momentum breaking to the downside before the actual price break for Adobe. So we could see a pullback in Bitcoin. If stocks drop into a harsh 4-year cycle low, everything will be infected to some degree, as margin selling will cause traders to sell any and everything. I've covered in the weekend report the signs we are looking for to take profits on all positions and get to the sidelines. This is definitely not a slam dunk, especially in an election year. The Fed and the administration will fight tooth and nail to prevent the 4-year cycle low from occurring this year. But if the conditions appear to ignite the move, there will be nothing anyone can do to stop it. We've already got one condition in place. The bank term lending program has pumped so much liquidity into the system, the indexes have gotten stretched way too far above their long-term moving averages. I've noted the parabolic structure in NVIDIA and SMCI in a previous tweet. This creates the potential for a sharp regression event. All we need is a trigger event to start the selling for this to come back to its 200-week moving average. Whenever you get stretched far above, that's when you get these big pullbacks. And we're very much stretched very far above that 200-week moving average. Nasdaq versus energy, this is another ratio. Retest complete. Energy should outperform tech going forward. This is your move lower, the retest of that peak, and then I think we could potentially head lower. I agree with that. I could see that occurring. Tavi says the Barron's and the Economist covers is all you need to know about the current state of the market sentiment. Right now, the sentiment is all pumped up on the stock market, Nasdaq and S&P. You're welcome to bet on lower interest rates if you want. You have the right to do so. And also, you have plenty of company. Knock yourself out. Best of luck. Tips versus treasuries and the CRB index both moving higher. And that will most likely result in higher interest rates, not lower interest rates, is what he's basically alluding to. Western Canadian Select or Canadian Crude Index is killing it. We're seeing a big move in the Canadian crude, which is benefiting the Canadian oil companies, especially the heavy crude guys. Here's copper. It's the old chestnut cup and handle setup. Looks like the path to $5+ per pound is clear. Folks, we've reached peak copper. Please apply seatbelts and put up your trays. It's going to be a bumpy ride. And we probably are going to launch to the upside. We've got a similar setup on a longer chart pattern for silver and a very similar setup in gold doing the same thing. And we could be hitting peak silver, peak copper, and peak gold all at the same time if peak energy, peak oil does occur over the next few years. That definitely could be the case. Goldman Sachs sees copper prices averaging about $6.80 a pound in 2025. There it is, and there's the deficits that are coming. Our inventories are low already, and the deficits are eating in to those inventory levels. And that's where I've got for today, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. We still have LEAP, L-E-A-P. The coupon code is still active. 50% off the first month to try it if you'd like, or you get a larger discount going to the yearly membership. That's all I've got for today. We'll catch you guys later. This is Finding Value.